Hi, I'm Martin McGrath. I'm coming to you today with a quick question we got the other day, and basically is, what's a franking credit? What's an imputation credit? I've heard of this thing before. What is it? Is it any good? What does it mean? And the answer is, yeah, it's really good. It's super helpful. Basically, what a franking credit tax credit is it's tax that's already been paid on the income you're getting. So typically it comes from a share. It comes from a share in Australia. So for an example, let's say CommBank, they're going to earn a profit, they're going to earn some money, and they have to pay some tax. They pay that tax at 30%. That's the company tax rate in Australia. The money they've got left over, they might pay as a dividend, they might pay to you. They might pay to your super fund. But let's say they paid it to you either way. You get that money, let's say it's $50 or $100 or $500 or $1,000, doesn't matter, so to speak. You get that money and you have to pay tax on it. But the good thing is, you get the credit for the tax that's already been paid. That's at 30%. So depending on when you receive that money, if it's in your personal name and you're not earning a lot of money, your tax rate might be 0 or 20%. If you've got a tax credit at 30, not only do you not have to pay any tax on that money now, but potentially you'll get some refunds of the tax that's already been paid, which is great. So you get that income basically tax-free plus potentially some extra money on top. Let's say you're still working, you're at a higher income and you're earning $60,000 a year or $100,000 a year. Your tax rate could be higher. It could be 34% or 39%. But same thing, you still get that 30% credit. So if your tax rate's 34%, you got a 30% credit, there's only 4% difference. And you basically got to pay a little bit of top-up tax on that amount of money. But if that was, say, rental property income you got, or if that was term deposit or cash interest you got, the same $500, you'd have to pay 34% on the whole amount. So $500 worth of interest or $500 worth of a dividend is a very different tax outcome. $500 worth of interest, you're paying 34% of the whole $500. Basically, because of the tax credit, you're only paying 4% on the dividend. A lot less tax because of that credit that's coming through. Let's switch that even to a more exciting thing. Let's say it's going to your super fund. The maximum rate of tax typically in a super fund is 15%. Therefore, you're definitely getting no tax on that dividend and usually a refund of those franking credits. If you're in retirement mode and you're retired, your tax rate in super is 0, the lowest tax rate you can get. And as a rule stand today, if you get $10,000 worth of dividends in your super fund and it comes with 30% tax credits, so it could be $3,000, how much tax do you have to pay on that $10,000? Nothing. What happens to those $3,000? They get refunded to your super fund. Extra income on top of that dividend. All of a sudden, that $500 dividend now, which is tax-free, ends up being $600 or $700 because of that franking credit on top. Massive difference, massive outcome, and a really good situation for anyone, whether you're working, low income, high income, or particularly if it's inside your super fund, some massive tax differences around that. So going back to the question, what's a franking credit? It's basically a franking credit. It's a tax credit for the tax that's already been paid. What does that mean? It reduces the amount of tax you've got to pay in any situation, and in some situation, it means you actually get tax back. So we look after a few self-managed super funds, and they're excited to do their tax every year because they're getting back $5,000 or $10,000 in franking credits coming back in tax credits. Hope that makes sense. If you want to find out a bit more about franking credits, all that exciting stuff and how it works, feel free to reach out. Or if you've got a similar question, more than happy to answer that if I can help you along those lines.